Okay, everybody, welcome back. Yesterday, I had kind of insinuated when I started my discussion about finance that finance had its own language and that it was a mathematical language. And today, Tuesday, excuse me, what I kind of want to do is I want to delve into that language. Now, I'm going to show you a lot of formulas, mathematical formulas, to illustrate that language. I don't expect you to memorize the formulas. I'm not going to test you over your knowledge of the formulas. Most of these formulas, you can go online, just Google financial calculator, and you can find online calculators that have the formulas embedded in them that you just enter the figures. It'll do the calculation. But to understand, kind of what's involved in it, I am going to show you the formulas. And I'm going to use the formulas to kind of illustrate some specific financial and economic principles that you should be aware of as an investor. So let's jump in here. When I said you're going to be an investor, that's because finance is investing. An investment is a current commitment of money or other resources with the expectation of reaping future benefits. You buy a share of stock today in the hopes that in a year, 2 years, 3 years, the stock will go up. When you sell it, you will make money. So you can define a sacrifice in much the same way. So investing does require sacrifice. You have to be willing to put that money away right now with nothing to show for it until in the future. So delayed gratification is also what we call this, which is putting off doing or receiving something small today in exchange for the expectation of gaining something more important in the future. And this is also the definition of opportunity cost. So you can see where investing, opportunity cost are kind of the same things. So we make investments in a lot of areas of our lives. Important investments include education and skills. Yes, learning is an investment, and I tried telling you guys that before we left the school. That yes, there's no incentive to be here. It's if you already have a high grade, you're happy with your grade, then there's no incentive to be here, and you can kind of see that by how many people actually show up for these lectures. But it is an investment. The knowledge you gain now is something that you can actually learn or use later on. So you have to be willing to put in the time now without the incentive to have that delayed gratification in order to use this later. So we do make investments in our education, our skills, our knowledge, our friendships, investments in food storage. This is why you might buy a big chest freezer, emergency funds, and finances. For the most part, we're going to be working with financial investments in this section of the course. Stocks, what are also known as equities, bonds, cash, treasury bills, also known as T-bills and notes, options, futures, a whole wide variety of investments. So just as money is not everything in pursuing a career, it is also not everything in investing either. It's important that we have a broader view of what an investment is so that we recognize those investments that are of the most worth. You don't have to put a lot of money into a relationship. You might have to put a lot of time in, but that's not money. And so you can kind of see if you want the investment to succeed, you could just sit at home and watch TV for very little money. You could have a date at McDonald's. It's more about the time. So that's just one small example of how money isn't everything in these investments that I'm talking about. You should have priorities, though, when it comes to your investments. So for you to understand your investments in the language of finance, you have to understand several key terms. And that's kind of what I'm going to go through most of the lecture today is some of these key terms. First, this is more like I'm going to read to you a dictionary of financial terms for a little bit here. So bear with me. We'll start out with an amortized loan. And I kind of introduced you to amortization and amortized loans when we talked about, in Unit 2, the microeconomics, and we calculated, the cost for the oven for Paul's Pizza Place. I gave that to you as an example of an amortized loan. So an amortized loan is a loan paid off in equal installments comprised of both principal and interest. So for example, if you're going to buy let's say a car, $10,000 car at 10% interest for 1 year, well then 10% of 10,000 would be 1,000. That's actually $11,000. I divide that up by the 12 months, and that's how much you would owe every month. That's the amortization. Now, obviously, a car usually is a 5-year loan, not a 1 year, but the 1 year made it very simple for me to illustrate. An annuity. An annuity is a series of equal payments, and these payments are made at the end of a specific time period for a specified number of time periods, generally months or years. Now, you may have heard those commercials. What's a J.G. Wentworth? It's my money, and I want it now. Who the heck are these people keeping their money? Why does J.G. Wentworth have to get involved? Because the money they're getting is coming to them in the form of an annuity, a series of equal payments made at the end of a specific time period. So for example, if you win the lottery, you can elect to get, let's say you won $2 million in the lottery. You could elect to get all that $2 million right now. Of course, they'll take a huge chunk of it in taxes from you. So you won't get $2 million. You'll be lucky to get $1 million out of it. Or you can defer that taxation and make it much smaller by taking it as an annuity. In other words, the state will send you like, $10,000 every month for 50 years or something like that. That will total the 2 million. That's what an annuity is. And those people who are not happy with getting the small chunks, because a lot of times if you're in a serious car crash and you win a lot of money in the court case, they'll annuitize it. So they're not paying you all that money at once, and it kind of helps their business a little bit to make it a regular expense. So these people who are not happy with the small monthly or payments or annual payments they're getting and want all the money at once, that's what J.G. Wentworth does. Pretty clever, because what J.G. Wentworth does is they'll say, okay, here's the lump sum. We'll keep getting the annuity payments. And those annuity payments, as long as you're willing to wait, the taxes are a lot smaller. You actually get more in the long term. And so J.G. Wentworth is trading your lack of patience and delayed gratification for more money for them. A compound annuity is an investment that involves depositing the same amount of money at the end of each year for a certain number of years and allowing the investment to grow. So something like an IRA, an individual retirement account, where the government allows you to put at least $2,000 in a year for an individual, $5,000 for a couple, and that is tax-free. And if you keep doing that $5,000 every year, then maybe after about 30 years, if you start off young, you'll take that out in retirement. Compounding, whether that's annually, quarterly, daily, etc., is the number of periods during the year where interest is calculated. So in the last unit, we had talked about an APR, an annual percentage rate. Well, that is a form of compounding that's compounded annually or once a year. So compound interest is where interest is paid on previously earned interest as well as on the principal. So if I put in $10 at 10% a year, well, then after the first year, I have $11. How much do I have the second year? Well, I wouldn't just add $1 because now I have $11 that's earning interest. So I would now have another $1.10. So I would have $12.10 in that account. And then the third year, what would I have? Well, I would add now $1.21 because that's 10% of the previous principal. And that's compounding. Albert Einstein called it the most powerful force in the universe. So obviously, the shorter the compounding period, the higher the effective annual rate of interest is. So if you're, compounding daily, you're going to earn a lot more interest than if you're compounding yearly. The effective interest rate, or what we also abbreviate EIR, is the actual rate as opposed to the stated or nominal rate that is received after the effects of compounding have been taken into account. So in my example of the $10 in the account at 10%, that 10% was not the effective interest rate, because you'll notice that I was getting more than 10% on that $10 after the second year or the third year. So whatever that was would have been the effective interest rate. Future value, also just abbreviated FV, is the value of an investment at some point in the future. If, for example, I leave my $10 at 10% in the bank for 1 year, I would expect to have $11 at the end of the year. That would be the future value of that money. The interest or discount rate is the stated rate that you will receive for investing at a specified compounding period for a specified period of time. So 10% annually on my $10 is the compounding, or the interest rate is the 10%. The compounding period is the year. The nominal return. This is the return on your investment before the impact of inflation or taxes is taken into account. So I put that $10 in, and let's say it's 1% a year for 10 years. And it's not compounding, just to make it simple interest. Then I would expect at the end of the 10-year period that I will have $20 in my account. Now, $10 today buys $10 worth of stuff. At an inflation rate of 0.5%, that $20 is only going to buy what $15 would buy today. So the nominal return would reflect the $20, but the actual purchasing power of that money, because of inflation and certainly the amount of taxes I would have to pay in capital gains on what I've earned, would reduce that. The present value is the current value, today's value of a future sum of money. So if I know if I put money in the bank today, if I put $10 in today, I should have $20 in 10 years. Well, that $10 today is the present value of the money. The principal. The principal is the money that you have available to you to invest or save. So the $10 I'm putting in the bank would be the principal. So it's the stated amount on a bond or deposit instrument as well. If I buy a $20 bond, the principal is $20. The real return is the rate of return on an investment after the impact of inflation is accounted for. So my real return on my $10 with that previously stated inflationary rate of 0.5% would be $15 in 10 years, not the $20 I would actually have. That's the real return. So the formula for approximating the real return is just the nominal return minus inflation, and we'll get into that. Reinvesting is taking money that you have earned on an investment and investing it again so that you take advantage of that compound interest. In other words, your interest starts to earn interest. And as I told you before, that's the key to being wealthy. That's the key to when you retire, you have $1 million in the account because you've not touched that money and you've let your interest earn interest. A tax-adjusted return is the return on your investment after the impact of federal and state taxes have been taken into account. So at the end of that 10-year period, I have my $20, but I have to pay a 30% tax rate. Well, then that would be, what's 33? That'd be $14 actually that I would have available to me after the effects of taxes. So as we stated earlier, compound is a very powerful force. However, how powerful is dependent in large part on the compounding period. So how will different compounding periods impact my investments and my investment returns? So here's another definition for you. Compounding periods just refers to the frequency with which interest is applied to your investment. So for a lot of investments, it's going to be an annual compounding period, an APR, annual percentage rate. But interest could be compounded daily, weekly, monthly, semi-annually, or annually. But a key relationship exists between the time and the interest rate. The shorter the compounding period, the higher the effective annual interest rate, because if I'm making 10% a day, well, then they're adding that 10% every day, and that interest is then earning interest on the next one. So instead of once a year going from $10 to $11.10 to $13.20, now I'm going from a day. And so within 3 days, I would have that $12.20 and then moving on. So for example, if interest is compounded daily, the interest will grow faster than if the interest is compounded monthly or annually. So finance does involve a complex terminology, but much of it can be reduced to simple quantitative formulas, which we'll demonstrate here. And while I demonstrate this, like I said, I'm going to use these formulas to also demonstrate some key financial aspects that you should be aware of. So the calculation for approximating the real return on an investment is merely the nominal return minus the inflation. However, the exact mathematical formula is 1 plus the nominal return divided by 1 plus inflation minus 1, or you can see here, real rate of return equals 1 minus the nominal rate divided by 1 plus the inflation rate minus 1. Now, as we move on in this class, the exact formula is what we'll be referring to. So an example of the real return or real rate of return formula would be an individual who wants to determine how much goods they can buy at the end of 1 year after leaving their money in a money market account that earns interest. So let's say they want to buy a house, for example. The house costs $200,000. If they put $150,000 in the bank today, after a year, would they have the $200,000 is what they're asking. So for this example of the real rate of return formula, we must assume that the individual wants to purchase the exact same goods and same proportion of goods that the consumer price index, the CPI, uses, considering that it is used often to measure inflation. So for this example, we're going to use the CPI, the Consumer Price Index, which is just a government collected data set that calculates the change in a select number of items for sale in urban markets and the changes in prices for all these items over a stated period of time. So in other words, the government goes into different stores and they say, okay, how much is a laptop computer? And they'll chart that, all these different stores, average it. And then next year or next month, they'll do the same to see what the changes in the prices are and see. Now, as the prices go up on the same product, same design and everything, you can kind of use that to kind of chart, okay, this is inflation when you average a bunch of goods together. And that's what the Consumer Price Index is. It's a measure of inflation. So for this example of the real rate of return formula, the money market yield is 5%, inflation is 3%, and the starting balance is $1,000. And using the real rate of return formula, this example would show the real rate of return equals 1 plus 0.05 divided by 1 plus 0.03 minus 1. And I won't make you do the math again. I'm not judging you on your knowledge of the formulas because there's lots of stuff out there where you can just enter the numbers online and it'll give you the amounts. But this would return a real rate of 1.942%. So with a $1,000 starting balance, the individual could purchase $1,019.42 worth of goods based on today's cost. And this example of the real rate of return formula can be used by checking or by multiplying the 1,019.42 by 1.03, the inflation rate plus 1, which results in a $1,050 balance, which would be the normal return on a 5% yield. But because remember, inflation will kind of eat away at purchasing power, which is why you want to, and if you recall in one of those market watch assignments, I tried to get you to the point where your investments should always return more than the rate of inflation. Otherwise, you're actually losing money, even though it looks like because of the normal return, you're gaining money. So let's look at the effects of compounding for a second. The formula for calculating the effective interest rate we had talked about earlier. The effective interest rate equals 1 plus the nominal return, or APR, divided by the number of periods to the power of the number of periods minus 1. Now, consider a stated annual rate of 10%. Compounded yearly, this rate will turn $1,000 into $1,100. However, if compounding occurs monthly, $1,000 would grow to $1,104.70 by the end of the year, rendering an effective annual interest rate actually of 10.47%. Basically, the effective annual rate is the annual rate of interest that accounts for the effect of compounding. So the following are examples of 4 investments with 4 different nominal returns. And which of these investments do you think you would rather own? Investment A, 12% annually. Investment B, 11.9% semi-annually. Investment C, 11.8% quarterly. Or investment D, 11.7% daily. Feel free to chime in if you have a choice. Well, either you're afraid to guess or you don't know. So remember, we said with the effective interest or the effective interest rate that actually you'll get more the shorter the compounding period. So in this case, your best option actually is investment D. Even though it has the lowest nominal return, because of compounding, it has the highest effective interest rate. If we look here, 12% in investment A is already represented as an annual rate. Investment B would be 12.25% annually. Investment C would be 12.33% annually, but investment D is actually 12.41% annually. So it has the lowest nominal return, but because of compounding, has the highest effective interest rate. And investment D would be the best vehicle, assuming you were lending money at this rate. In other words, I want you to see how important compounding is, that it does make a difference in your money. So far I've given you 2 financial things you should really know. In the rate of return on investment should beat inflation, and that the compounding period matters. And if compounding is really what makes you money on an investment. So let's suppose you want to determine the current value of the ultimate earnings on an investment. And this question could be restated in the following manner. What is the present value of my investment that will mature in N years at I% interest? To solve this problem, you'll need to know the future value of your investment. In other words, I'd like to buy a $300,000 house in 20 years. How much money would I need to put in the bank at what interest rate today to have that $300,000 in 20 years? So you're going to need to know the future value of your investment, how many years are required for the investment to reach maturity, and what interest rate your investment has. And the result of the equation will be a dollar amount that is smaller than the future amount of principal and interest that you will have earned. It's the amount that the investment is worth at the present time. So the present value equation can be stated as follows. The present value equals the future value divided by 1 plus the interest rate to the power of the time period. So in this equation, n is the number of periods, years in this case, in which interest is compounded. But if you had interest compounding monthly, you certainly could fill in that for n there. So the key inputs in the present value equation are as follows. FV is the future value of the investment at the end of n years. N, the number of years in the future, or months or days, depending on what the compounding period is. PV equals the present value in today's dollars of a sum of money that you've invested or plan to invest. So after you find these inputs, you can solve for the present value. And you must remember that money you will earn in the future is less valuable than money you have right now in terms of opportunity cost. Why? And there's an old saying that goes with this. A bird in the hand is worth 2 in the bush. Why? How certain is that money in the future? Let's put it this way. You're selling something on a Facebook group and you want $100 for it. Let's say you're selling an old phone. You want $100 for it. Someone comes to you and says, I have $100 to buy your phone. Someone else comes to you and says, listen, I don't have any money right now, but in 2 weeks, I'll give you $150 for the phone. Who do you sell it to?
The $100.
Exactly. Because why? They have the money right then. $100 in your hand is a lot more certain than $150 in the future. A bird in the hand is worth 2 in the bush. The 2 in the bush you still have to catch, and there's no guarantee you'll catch it. The other reason that this money today is worth more than money in the future is inflation. Without inflation will eat away at the value of that money. And so $100 today will buy $100 worth of today's goods. That same $100 in the future will buy less than $100 of goods because inflation is something that continues to go up. So in terms of the opportunity cost, the money you have today is worth a lot more than the money in the future. And this is because you cannot use future money to earn interest today. You can only earn interest with money you have in hand and can invest. So now let's try to solve for the present value. Let's suppose that your rich uncle promises to give you $500,000 in 40 years. Now, assuming a 6% interest rate, what is the present value of the money, the amount your uncle is promising to give you in 40 years? In other words, how much money is he actually putting in the bank today at a 6% interest rate to get you to $500,000 in 40 years? Now, let's suppose that, so if we plug this in, the present value is what we don't know. The future value is $500,000, assuming a 6% interest rate. So we have 1.06 to the nth, and that the nth is 40. And I'm just going to jump ahead here to show you the math. So we have $500,000 divided by 1 plus 0.06 to the 40th. And what we get when we do that math is the present value, how much he's putting in the bank today to give you $500,000 in 40 years at 6% interest, is $48,611. Now, how do you get $1 million or $2 million in your bank for retirement? There you go. If you want $500,000 for retirement, start saving as early as possible for retirement, and all you have to do is put in about $48,611, assuming a 6% interest rate, which is fairly reasonable. Now, let's go back and look at our other problem here. Let's suppose that in 5 years, you'll want to buy a house in a particular area, and the average home cost there at that time is estimated to be $350,000. How much would you need to invest now if it would grow at 7.25% annually to pay for the house in total? In other words, if you could stand living in maybe a subpar apartment where the rent's kind of low, driving a beat up car, in order that in 5 years you could actually live in a really nice neighborhood and a nice home the rest of your life, how much is that actually worth that you would have to actually put in the bank today to get there? So let's do that math. The present value equals $350,000 divided by 1 plus 0.0725, that's 7.25% annual interest rate. And the number of years we want to invest is 5 years. So it's 350,000 divided by 1.419. So today, in order to buy that $350,000 house in 5 years, you'd have to put $246,650.24 into the bank. You might not be able to live in a nice home those 5 years, but you know in 5 years it'll be coming. And look, you save over $100,000 by just being patient and delaying your gratification and waiting for 5 years. Very important financial concept. The wealthy get wealthy because of delayed gratification, suffering for a little bit to get something better in the long term. So any questions about what I've kind of gone over today? What I plan on doing Tuesday is continuing this, showing some more financial, enlightenment type stuff to help you understand how money works and how investing works. So do you guys have any questions for today?
I don't think so.
All righty, man. Well, you guys have a good weekend then, and hopefully I'll see you all again on Tuesday.